Moving on now, Wall Street top analysts are betting big on commodities for the rest of this decade. Well, that comes amid a historic oil shock due to the Iran crisis. Those bet lines up with higher returns in commodities versus other assets during red-hot inflationary periods over the last century. Well, the Bank of America is betting on commodities. They expect commodities to replace stocks and bonds as the biggest winners of 2026 to 2030. In a note to investors, Bank of America Global Research Chief Michael Barnett has written about bubble risks in stocks and bonds currently. He noted that instead of real demand and productivity, it is a debt and liquidity play going on in those markets currently. Barnett calls the bubble a boom loop and expects that trend to continue. However, he said that the US 30-year Treasury yield of around 5% is in the danger line, which looks likely to be the reality soon. Barnett warned that once this line is crossed, the bubble will break. Bank of America suggested that inflation, supply chain risks and the global race to monopolize critical minerals will boost commodity prices. And separately, the world's largest asset manager, BlackRock, is making a historic pivot to commodities. That is being powered by the firm's risk engine Aladdin, running 5,000 risk scenarios per day. And traditionally, BlackRock follows the 60-40 investing rule. That is 60% in stocks and 40% in bonds. But for the third time in the last 50 years, BlackRock is moving a part of client capital from bonds to commodities. BlackRock says that the prevailing supply shocks will act like a tax on consumers. Well, the asset management firm added that gold, copper, uranium, energy and other commodities are their plan B. A 2021 study by Duke University and Man Institute analyzed inflation data from 1926 to 2020 in the US, Europe and Japan. They identified 8 distinct periods when inflation was trending above 5%. In each of these 8 inflationary periods, commodities proved to be the best performing asset classes. Well, commodities returned 14% on average annual real returns. And on the other hand, the S&P 500's real returns were negative 7% on average during those periods. Real return is defined as inflation-adjusted earnings.